Okay, so now that we've seen how to model out a very simple series seed round, we're going to step back just a little bit and work on convertible debt and how to add convertible debt in, because convertible debt is generally the first money that you'll raise, and that will then convert in the series seed round. So let's take a step back and add in some convertible debt. We'll do that by going in here, say column C, and inserting about 5 new columns. We'll clear the borders in a minute. So, in order to do this, let's go in and add a couple more rows here, and come in and type in convertible debt investors. And let's call this guy CD for convertible debt angel. And CD Angel comes over here and invests, let's say, doesn't matter, $100,000. And so we'll go up here and label this column amount, and then go next door and label this discount. So usually whenever convertible debt is invested, it's invested with different terms. So one of those main terms is the discount. So the discount is the discount to the share price of the next round. So if this $100,000 converts into the series seed round, it converts at 80% of that $3.37 share price. If we have a 20% discount, that can be a 30 or 40% discount, but 20% is standard. So we'll add in 20% here. Now we need a time coefficient. So that's to calculate the interest that accrues. And we'll do that in years. So generally a convertible note time period is about 2 years. So let's just put a 2 right there. And then we have a rate column. Standard interest rate on convertible debt is about 8%. It can vary, but what you generally see is about an 8% interest rate. And then lastly, what some convertible notes have, and this does add a definite level of trickiness, is a valuation cap. So the valuation cap means that if the next round in which the convertible debt converts has a higher valuation than the valuation cap, then the convertible note converts at the valuation cap. Also, one thing of note is generally, if you converted the valuation cap, you don't get the discount, or vice versa. If you get the discount, you don't convert at the valuation cap. The language typically says the lesser of. So you may be, the valuation cap may seem like the best deal, but it might not be in reality, because the discount actually gets you a lower share price than it would if you converted the valuation cap. So it's just something to keep in mind, and we'll work through modeling that out too as part of this spreadsheet. So let's say that on this round there's a valuation cap of, let's just put it 5 million. Well, actually, let's do 6, so it's over the post money. No, 5 is. Let's do 5 million. So these are all things that we directly inputted. So what we're going to do is go in and highlight them yellow to make sure we know those can be manipulated.